Would you rather spend $30,000, for $1 million account, right? So let's say $1 million account, 1%, $10,000 a year, 3 times revenue, which is what some of these books are being marketed at. Would you pay $30,000, or clearly people are paying $30,000 for $1 million account, but they're like, I don't know if I want to spend $10,000 to get $1 million account with marketing. I'm like, what?
Hi, everybody. Welcome back to the Don't Do That podcast. I'm your host, Kelly Waltrick, and here with me today, I have Chuck Failla, founder and CEO of Sovereign Financial Group. Hi, Chuck. How you doing?
Kelly, real good. Thanks for having me on your show.
Chuck, you and I are like ships passing in the night. You're always like, I'm going to be at this event. I'm like, I'm not going to be there. I'm going to be at this event. And then this is our time. This is our time together. I'm very excited.
The stars have aligned.
The stars have finally aligned. So, guys, before we get it, I always get to have a little bit of friendly banter with my guests before we get on and we start telling you things. We edit some things out, things you're not supposed to hear. But Chuck was just telling me about the exciting growth of his firm. So Chuck, I'd love to hear more about that. What do you guys have going on? What's working for you? Where are you in the evolution of your firm? Tell us all the things.
Well, I know we were joking a bit off camera, the more AUM, the more problems, right? And that's a little bit of what we're seeing, which if you are going to have a problem, a lot of new AUM coming in is probably the problem you want to have.
Yes.
But what's interesting, to me at least, I guess, a handful of years ago, Sovereign was a lifestyle practice. It was $100 million, me and a junior partner, period. And then over the past 5 years, we've now grown to over $1 billion. We're touching $1.2 billion right now, 20 advisors and a support staff of 6.
Wow.
So phenomenal growth, which of course I could not be more pleased about. But I tell you, there's a huge difference, as you well know, running a $1 billion, I would say we're a small enterprise, right? Or we're a really huge small firm, whichever way you want to look at it.
Right.
As opposed to running a $100 million lifestyle practice. And it's been a lot of fun, new challenges, and it really comes down to people. And we've had to get the right people in place, and that's making things a lot better. But let me tell you something, 2025 was a busy year for yours truly, because I was filling a lot of different seats.
Oh,
but
my
now
goodness.
It's much more comfortable.
Well, congratulations on that. That's amazing. Do you know how many firms come to me and say, hey, I want to go from $100 million to $1 billion, and you get to give us the masterclass today? How'd you do it?
Yes. I tell you what, we built a really interesting platform, and essentially I built a platform that I always wished existed. And that really is just the key, right? So I am still a financial advisor. I meet with clients every single day. So not only am I, the founder and the CEO, I'm also an advisor at Sovereign. And what I did was put together a system that allows me to run my business very efficiently. And I'm a huge fan of e-money. I love e-money. And more broadly, I'm a huge fan of cash flow-based financial planning, right? As opposed to goals-based. Goals-based, we get the speedometer and you have like a 85% chance of success and all this. I don't go for that.
Yeah.
Not for me. As an aside, you know what else has an 85% chance of success?
Oh boy. What?
Russian roulette. It does. It has an 85% chance of success. Most revolvers are 6 shooters, right? So that means you have a solid 5 out of 6 chance of not getting that one bullet. At that point, 85% doesn't sound too good, does it?
No,
right?
no. Nope.
But that is something else that has an 85% chance of success, Russian roulette. So I don't care for that. I like cash flow-based planning, which means e-money, also Right Capital and Orion planning. They're all kind of kissing cousins. So everything I do is based on that. But where I was, and I love where I was at Raymond James, the independent broker-dealer channel, have nothing but great things to say. But that platform was not built specifically for me. So I launched Sovereign really to have a platform that was built specifically for me. So everything we have literally ties into that 5-year cash flow report, our turnkey asset management program, our aligned fund, everything is designed to make my life easier. Then once we built that, and we had some stumbles with it, but it's built really nicely now, I just opened up the doors and say, hey, any other advisors out there love e-money as much as I do? And if so, come join us.
I love that.
And that's exactly what we did. And I will put us up against any other firm out there if the advisor is an e-money or Right Capital or Orion planning, basically a cash flow-based financial planner that uses that 5-year cash flow report. I don't think there's a platform out there that does what we do. And it was really designed to make my life easy. And then once it was made perfect for me, and I'm very picky about stuff,
we
just opened up the doors to other folks. And in came the growth. It was really an amazing thing to say.
That is so interesting. I love money as much as you. You know, I came from there, right?
That's right. I
I
forgot, but
did.
now that you say that, and
I
I'm
bet
not
you.
plugging you money for that particular reason. I happen to be a huge fan of them, but yeah.
Yeah, that's so awesome. I'm sure there's lots of eMoney alumni listening to this podcast. I have never heard that as a focus before. I mean, I've heard eMoney as a focus, but the specific platform building is super interesting.
Yeah. So essentially, we could take that 5-year cash flow report, which all of us e-money fans know and love,
Yeah.
and click, 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 literally 3 clicks. It's in the trading system, and then our traders rebalance around that. It's really very elegant. And, what I tell folks is I run a $250 million book of business every single day as a financial advisor. I run Sovereign. As you know, I do a lot of work at the conferences covering it for Investment News and Go RIA. But it's only because we made the system so efficient where once I'm done speaking with my client, I'm done. Everything else is taken care of by the systems. And it was hard to build, not easy. And we were punching way above our weight at $100 million. Like,
Yes.
some of our vendors like, are you sure you want to do this? That seems ambitious for such a small, tiny firm. And I was like, no, we want to do that. And we basically built it to be a $5 billion firm when we were just 100 million. And now we're 20% of the way there.
Okay, so what was the catalyst to go from lifestyle practice to turning on the growth engine? Like, what was it in your life that told you this is the moment?
Yeah. So the real moment was realizing I shouldn't be at a broker dealer anymore. And as I think you might know, Investment News called me out last year as public enemy number 1 for the broker dealers for all the work I do on Go RIA. And I wear that. It was a 2-page spread in the actual print magazine. And I wear that truly as a badge of honor. But it's simply this. I wasn't dropping tickets. I was like, why am I tithing back so much money to a broker dealer that I love? I've got nothing but great things to say about Raymond James. But I was acting as an RIA within their broker dealer construct and being restricted on investment choices, being constricted on marketing choices,
Yep.
and being constricted on my payout. And I was like, why? And I was like, you know what? Let's just do this. And once we went RIA and I dropped my 7, dropped my 24, which I had for a quarter century at that point. That was scary. But it didn't take more than 6 or 12 months to realize that, man, I should have done this a long time ago. And once we built it, we said, if we built this the correct way, we're not going to be a perfect fit for everyone. We just want to be a perfect fit for a very small niche, not small, but a niche of advisors that love cash flow planning as much as we do. And for those advisors, we want to be the absolute best. And I think so far we are.
Okay, so something you said there caught my ear, limitations on marketing. So I am actually in the process of doing quite a bit of research on this at the moment because, as you can imagine, Intentionally works with firms of all shapes and sizes, all affiliation models. We work with broker dealers, we work with RAs, and I love that. I love having the mix. I love having our finger on the pulse of all the different business models. But I am spending a lot of time researching firms that aren't independent and the options that they're giving their advisors for marketing. Because here's the thing. I, again, am agnostic to business model, but if you are going to have advisors at your firm and it's not an independent model, you have to provide them with the appropriate means to grow. So I'm digging in deep here, I will tell you, and I'm gonna put out some research and some things around this because I think we're in a new age and we're evolving, and organic growth is the name of the game, and everybody's trying to figure it out, and you can't have barriers in your way. So again, model aside, if you're not going to be in the independent space, the firms that win are obviously going to be the ones that provide centralized support.
Mm-hmm.
So if you are listening and you are one of those firms who is nailing it from a centralized support structure, I want to talk to you because I feel like they are few and far between,
Mm-hmm.
Everybody says we give you the engine to grow, but I'm having trouble finding ideal ones, which is an ever-changing, target, to be honest, but I'm on the search for sure.
Yeah. So I think that's important. And when you say centralized support, I think that has a lot of different facets, right?
Yeah.
So we look at it in a few different areas. Number one, and I love to brand things, and I'm sure you can appreciate that.
I do.
If I could slap an acronym on it or
Yes.
a tagline, I'm doing that.
Yeah.
So we have support as a service, right? So we have advisors. So our target market tends to be the sub $500 million advisor. And really the sweet spot is the $50 to $100 million advisor. That's kind of our real sweet spot. And for those advisors, they often don't need like a client support person. So we create a support team that everyone can plug into on an hourly basis. Then also we have the trading platform, which we call Align, and we price that at cost, right? So we try to take as much off the plate of the advisor that they want, but not everything, right? Because I like the a la carte system. And that was something else that always bothered me at the larger broker dealers or even the larger IBDs, where it was kind of like the same pricing across the board. And I wasn't using most of what they offered because I didn't frankly like it. So when we built Sovereign, we wanted it to be more a la carte. Do you want us to do your support? We'll do it. Here's exactly what it costs. And you can track it in your advisor portal, how many minutes was talking to this client, how many minutes was talking to that client. Then we also have trading. They're all trackable, all a la carte. And we have marketing, right? Which I think would be right in your wheelhouse too. And that is something that is so conducive for centralization, right? So rather than having, 20 different advisors whose average AUM is, whatever, $70 million, give or take, all doing their own, discrete marketing.
Right.
Why not centralize that? Anything centralized is going to make more sense. And once we started providing that, it was very well received. And I feel the a la carte system, for me at least, and again, I built Sovereign perfect for me, and it's going to be perfect for anyone else that likes the way I like to do things.
Yeah.
If I'm being honest, if you don't like that, if you like everything, sort of, prepackaged and, like that, then we may not be as good of a fit. But I built it for what I think works best. And I've been doing this for 30 years, and I've got some pretty meaningful opinions on how to best run a mass affluent financial planning firm. And that's really what we are. We target the mass affluent. And a la carte, I think, makes much more sense, especially on the marketing, because some advisors don't want to be plugged into the marketing. Some of our advisors are really great crackerjack marketers. And, we allow DBAs, they could do their own business. We also support them. There's one advisor actually that's looking to go off, start up his own ADV and use us purely as a back office. And we call that Sovereign as a Service. So we give them a lot of optionality. And I think that's important, especially when people are looking to break away. What type of optionality do they have day one, but also what optionality do they have in 10 years? Where they might graduate from us, look at us as an incubator, and then want to set up their own firm. And we have a pathway to that too.
I love that. Yeah, it's interesting. I've just been curious lately, and I posted it on social media a couple of weeks ago. Like, I'm curious lately if maybe marketing, and I'm obviously biased on this, but if maybe marketing is not a high enough priority as firms are going through their M&A process. It feels like more of a check the box thing from most of the firms that I've talked to versus like a decision maker. And I think that should change.
I think it's critical. There's only so much you want to buy books. And I'm not a big fan of buying books, to be honest with you. Number one, the prices of purchasing books, I think, is through the roof. And then also you're getting clients that are not indoctrinated in the way that you like to do business.
Yeah.
So now you got to re-indoctrinate all these clients. So isn't it better? And I was in a Kitsis presentation once, and I've had the chance to speak with him a number of times on our podcast here, and he always has great things to say. And he really put some good light on that. And I think this will resonate with you. Would you rather spend $30,000, for $1 million account, right? So let's say $1 million account, 1%, $10,000 a year, 3 times revenue, which is what some of these books are being marketed at. Would you pay $30,000, or clearly people are paying $30,000 for $1 million account, but they're like, I don't know if I want to spend $10,000 to get $1 million account with marketing. I'm like, what? How does that not make sense to you?
Chuck,
right?
This is the story of my everyday conversations with all these firms. I try to push people to get serious about client acquisition cost and what they're willing to spend, because the conversations are wild. And it's so interesting because the LTVs in our space are so favorable. It's sort of amazing to me that math is not more clear to more advisors.
It doesn't math to me. $30,000, let's at least $20,000, right?
Yeah.
There's no book I know out there that's for sale for anything less than 2 times revenue, right? So $20,000 for $1 million account. And this is a person now I got to work hard to trust me because, that client doesn't know me from Adam. He's just being sold to me. Or spend probably half of that, $10,000, to get $1 million account that's already choosing to be with me.
Right.
And I think that's even more relevant than the price. But, I'll pay $10,000 for $1 million account all day long, way before I'll spend $20,000 for $1 million account for someone that I got to cultivate for the next year and maybe doesn't even stick because it's not a cultural fit. So I think that's an obvious thing, but when people really look at the math, I don't know how you come to a different conclusion. Spend the money on the marketing, forget about buying books. I don't want to buy a book. I'd rather just get my own clients, as I've been doing for a few decades now.
That's super interesting perspective. I feel like I've had a lot of people on this show doing the exact opposite. I don't know what's right, but you know what? I think about the same way that you just defined buying leads. So I have a lot of firms who come to me and they say, "Hey, I'm buying leads from the firms. I'm not gonna name them." And I think there's a time and a place for that. When you are large enough to be diversifying your lead generation sources, that's great. But to your point, those people are coming in and they still don't know who you are. You're starting from zero. You're not starting from the dollars that you put in to get that lead. That firm gets the benefit of that brand awareness and brand visibility. You are starting back at zero. They have no idea who you are. So I spend a lot of time talking to firms about $1 spent on your own brand visibility and your own advertising and all those types of things versus buying leads that still at the end of the process don't know who you are. So very similar sort of thought process there.
And I think they have to put some sort of value on the amount of time you've got to put in to cultivate that lead. Whereas someone's coming in from your own marketing, they already buy into your message, buy into your narrative, buy into your value proposition, and they're already there, right?
Yep.
You don't have to take another client, from another advisor or a lead from another advisor. But I will share one other thing that I'm most excited or equally excited about, if nothing else. So we're launching, and one thing that's really nice about scale, and again, at $1 billion, we're a huge small firm, and I recognize that, right? But we could do a lot more at $1 billion than we could do at 100 million. That's for sure. Like we were like, let's take this cash flow for a test ride and let's do some stuff. And we're going to buy an accounting book, like an accounting business.
I love that. That's so smart.
Get that in. And I think it's going to be great for client retention, value proposition, so on and so forth. And then once we work out the kinks there, because there's an awesome, and I'm almost hesitant to say this because I don't want too many other people doing this, but just between you and I
don't know if that's going to be.
But I just think it's a great idea. And I'm a big believer in, there's plenty of clients out there to go around, for the good advisors. But if you look, there's a real meaningful arbitrage between the value of an accounting client and the value of a wealth management client. Huge arbitrage, right? So you can buy an accounting business usually for about 1 times revenue, right? And there's a lot. And I would bet dollars to donuts that is going to go down. Why? Because of AI, right? AI is going to be a real problem for a lot of accounting firms because it's going to get easier and easier and easier for either people to turn DIY for accounting, especially for the basic stuff, or for accounting firms to be able to do a lot more with less, which kind of brings the pricing down. But what's nice about that, once we get our first one done, and we're talking to a couple of different accounting firms right now, then it's just a matter of putting it into our favorite thing, which is a process. Everything we do has a process. Nothing is done too differently. Very rarely will we do something differently. And then you start buying other accounting businesses once you have that process done. And even if you're breaking even on that accounting book, now you have a beautiful pool of highly qualified leads. And I think that's going to be a very exciting way to grow as well.
I love that. We actually have a client here at Intentionally that has a similar strategy. Another firm, I feel like buying firms that provide lead is super smart. And there's lots of different types of firms that you could do that with. I love it as a growth strategy. I think it's super smart. Okay, so something you said, accounting firms, it's going to make it a lot easier to DIY. So here's how I've been thinking about all these things that are going to be a lot easier to DIY. Just because they are doesn't mean you want to, right? Like, I can clean my house. Do I want to do that? No, I don't. So like, how do you think about the firms that people are going to be able to DIY things, but still not versus the firms that are going to be able to be DIY'd and get wiped out?
Yeah, within the context of wealth management?
Yeah.
Sure. I think it was Josh Brown that recently went on record calling a victory against the robo or the robo advisor instead or something like this. I love Josh Brown.
Me too.
I do. And I think that's true. So my 2 cents on the whole robo advisor thing, which I think is what you're getting at with this, the DIY, that will absolutely always be there until that person gets real money, right? Yeah. And I talk about this a lot. So what we like to call the KOCs, right? I love acronyms. KOC is kid of client. So the KOCs, that generation tends to be very DIY oriented, right? And they will be right up until they inherit the $3 million from mom and dad. My point being is, most people are not going to feel really comfortable when they're going from a liquid net worth of $25,000 to $3 million and think they're going to execute on proper financial planning with regards to that. And that's, I think, what Josh was probably really getting at is DIY for our target markets. I think that's pretty far away. Great example. One of my clients, was like, oh, I did some research on, ChatGPT. And I was like, all right, we'll take a look at it. And I was like, this is nonsense. It was really bad. And I love ChatGPT. I really, really do. But what I told him, you got to be careful because ChatGPT, or I like to call ChatEG, will give you all kinds of wacky stuff because it starts that hallucination and it tends to want to kind of kiss your butt a lot. Be like, that's a great idea, so-and-so. You really should do that. And people are like, dude, if I were to do that, I would be completely liable for malpractice. It was
oh my gosh,
telling him to do some wacky things. So I'm not too worried about that. I do think you need to provide value. And what I tell a lot of younger advisors, especially, and most of them get it, is that you cannot rest your book of business on charging a fee for picking the best stocks or picking the best funds. Right. That is done. That is a commodity. You better be sure you're providing value way above and beyond that by way of planning. And soon, and this is another reason why we're going into the tax prep business, I would say in 10 years, maybe sooner, but certainly in 10 years, clients are not going to have their financial planning person, their accounting person, and their estate person. It's all going to be combined, either officially under one roof as we're looking to do at Sovereign in one like actual ecosystem, or at least some sort of virtual ecosystem where there's a strong connection between the advisor and the CPA and the estate person. They're all going to be communicating much more regularly than they are these days on average. Some advisors do a great job with this, of course, but not all.
Right.
And then for the firms that are really looking forward, as we are, we're going to put that all in under one roof, right? So we're starting with the accounting practice, then we're going to bring in an actual estate attorney and have it all there. And that's the beauty of scale, because my book of business doesn't justify my hiring an estate attorney, but Sovereign as a group of independent advisors can share an estate attorney, can share an accounting practice. And that really is the beauty of scale when it's done properly.
Very smart. Okay, Chuck. So we're at that point in the show. And guys, I got to tell you, before we hit record, I have the same conversation with almost every guest. And it goes something like, hey, you're going to tell us a mistake you made. And the person on the other end says, ooh, how much time do you have? And I love it, Chuck. I love it because it's so nice to know that smart, successful people have made lots of mistakes. It's why I've created this show, because I want everybody listening to know that. I want everybody to know growth isn't a straight line. And I want everybody to know that the smartest people don't avoid all the landmines. There's just no way, right? There is just no way. I am humbled every day by something crazy in entrepreneurship. Anyway, So Chuck, what are we not doing today?
Yes. So as I did say off camera, there's a long, long list for me to go through. And I'm someone that has zero problems with mistakes, zero problems with failure. And you talk to anyone that's had any kind of success, and whatever success I have had, which is moderate, I wouldn't say it's, gangbusters, but I'm happy with it. There's no one that's had any level of success without failure. You cannot have one without the other. It doesn't happen. So if I were to pick just one to keep us within the time constraints of this podcast, it's when I first went RIA, which again was about a handful of years ago. And we have a very, very specific trading methodology where we leverage portfolio groups. And that's key for us to implement that seamless interlock with e-money and right capital and so on and so forth. So we need portfolio groups. They are critical. Yep. And that would be a whole great episode because I think too few advisors are using portfolio groups. Many don't even know what it is. I think it's critical. So we looked at XYZ vendor that had, a great reporting system and a very nicely developing trading system. And they said, portfolio groups, it's on the roadmap. By the time you guys get transitioned and settled in, you'll be fine. Shame on me, right? Because I was like, okay, that sounds good. I'm sure he wouldn't exaggerate the timeline on that because this is so important for us. And there we were, 8 or 9 months later, and I was like, dude, where are these portfolio groups? And like, well, we're having some issues. And that was just a mistake. So such a mistake that I had to write $1,000 check to get out of that contract, which was painful to write. And it was a very loud day in the Failla household. I was not pleased. But worse than that $50,000 check I had to get out, even though they were not really truthful on their timeline, we had to migrate all this data out, which was worth even more in cost, like time, frustration, hassle, opportunity cost, and the 50,000. And we switched over to another trading system, which we are now, and we're very, very happy with. That was a mistake. So what I would say is don't do what I did. And if there's something that's mission critical for how you want to create your firm, do not accept it's on the roadmap, because it may never come to fruition. Ironically, the firm we're with now, we're happy with the trading, but we're getting less happy with the reporting, and the reporting is better at that prior firm. And that's
So,
part of the nature of being kind of picky. I mean, I like things to be really, really, really perfect. So, we're talking right now with our current provider that they should be able to do a few things that they need to do with their reporting system. And I think they will get there.
guys, how many of you listening to this have been duped by it's on the roadmap? I feel like I've come from a tech company, or multiple of them. And so I know that that's code for I have no idea, but hopefully my service team will figure it out when you get here.
Yeah. But just sign, it'll be fine.
Oh my gosh. Yes.
Painful.
I would say if it's mission critical and it's on the roadmap, you're right, don't do it. But if it's on they're saying it's a short time period, then write it into your contract, right?
Yeah.
My gosh.
At a minimum, and that's really what I should have done. At a minimum, have an exit clause. Like if XYZ doesn't happen by a certain date, talk about insult to the injury, right? So the injury was not having it come to fruition. The insult was I have to write a check for $50,000 to get out of a contract that you promised me would be okay. That was just a stupid mistake on my part. But one thing about really big, stupid mistakes, you almost never do them twice, because you just have such muscle memory to never do that again.
Yes.
And I'm pleased to say that I haven't, but man, that was a problem. But yeah, just write it into the contract, because man, if I could say one other thing about these tech vendors, God bless them, some of their contracts are pretty short, except for this one URL. And Ellie, I'm sure you know exactly what I'm talking about.
Yes.
Do yourselves a favor, click that URL, because that's where all the bodies are buried and all the terms that they will hold you to if you want to get out of that contract. So the contract often looks like a page or two of real friendly, big font, all this other stuff, blue soothing colors for the title, headlines, and all this. But that URL that has, I forget what they call it. I think it's their terms of service terms of service, TOS, TOS. Click that and read that, because once I click that, it made it clear that I'm going to have to write a check for $50,000 to get out of this thing. And that's a mistake that's easy to avoid. You got to read those contracts, especially for these big 6-figure annual contracts, which a lot of these tech providers are.
Yeah. Okay. So is there ever a time when it's okay to buy based on the roadmap? And I'm asking you this very specifically because we have some very exciting things happening in wealth tech right now. Like, we have a lot of new players in the space. We have a lot of new capabilities. AI is adding this layer of intrigue, and a lot of these companies are young and still figuring out, but very, they're bringing things to life at a pace I've never seen. So is there ever a time that we buy based on the roadmap, or what do you feel?
Perhaps. And I would say it would be for this reason only. If there's no other better solution.
Yeah.
Right. If that's going to be as close as it's going to get for you, then yes. But again, just make sure you have it written into the contract that if by a very specific date, something very specific doesn't happen, you can get out, and even maybe some sort of reimbursement to cover the cost of migrating out, because that is not free.
Right.
So that would be the only way I would ever do that again.
Yeah, that's interesting. I feel like we're in we're an interesting time in wealth tech. And I think what we're going to see over the next couple of years, we can't predict in terms of the winners and the losers and who's going to innovate and who's going to get left behind. And so I feel like even maybe the best laid contracts are going to be at risk.
It's
here
possible.
Soon.
It's possible. I forget who had this quote fairly recently, and I'm sure a lot of people are saying something like this, but it's not that AI is going to replace us advisors, but advisors that use AI will replace advisors that don't. And I think that's spot on correct.
I just had Reed Colley on the show from Orion. We were talking about all the ways that they're innovating and all the ways that they're infusing AI, and that they were going to announce at their conference and all that kind of stuff. And I just asked him, I said, there's a whole industry of people that maybe doesn't think Orion's going to be able to move the large ship fast enough. And he was like, yeah, if I didn't know all the things that we were doing and working on and being deep in it, I would think the same thing. So I think it's going to be fun to watch unfold what advisors like you have access to over the next couple of years.
Actually, I interviewed Reed at the Orion conference just recently, and he was talking about that Denali, which is what you're referring to there.
Yeah.
And especially off camera, he shared some pretty interesting
I know.
talk about roadmaps. It was pretty cool. And I think it's going to be neat. And what's nice about it, there are no shortage of firms trying to attack AI for wealth managers. And we're all the beneficiaries of that.
Yep.
Right? Real good competition. It's like the opposite of the old cable companies. No competition, no innovation. Hyper competition, we're waiting to see what's going to happen. At some point, we're going to choose one. We're going to choose one next quarter, actually. We have a short list. We know all the usual suspects.
Yep.
But I think the right AI partner is going to take our systems, which I already love, up to the next level. And, the more we can deliver for our advisors, which we consider clients, right? So we're a platform. And the more friction we can remove, I think that's going to be great for all involved, and especially the end client, right? Because there's only so many hours in a day. And if we could take all the minutia off the advisor's plate, which is what we strive to do,
right,
we feel we're doing our job if all our advisors need to do is talk to their clients.
Yep.
And once they click end on Zoom or walk them to the elevator, if they're doing in person, there should be nothing else that advisor needs to do. And I've always believed that, even back when I was a stockbroker 30 years ago. And I told my staff, if you see me with a pen in my hand, someone is not doing their job.
Interesting.
All
I like
should
that.
be doing is and this is, me, Josh Brown, we reminisce about the old cold calling days all the time.
Yeah.
We were both New York City cold call cowboys. But I used to tell, my staff that when I was a broker, right? I should just be on this telephone because that's my best delivery of value.
Yep.
If you see me with a pen in my hand, meaning I'm writing something, that means someone here is not doing their job. And as a team, we're not going to make as much money. Because as a team, you want me on the phone selling. You want me on the phone developing relationships. That's what I'm best at. And that's exactly the philosophy we have at Sovereign, that advisors should not be processing anything or filling out papers. If they're an advisor, if you have the ability to get someone to sign a document to ACAD in millions of dollars, all I want you to do is that. We can find a lot of people at a much lower price point to fill out that ACAD form. You should not be filling that out.
Very true. All right, guys, to all you listeners out there, I think Chuck gave you all a pretty good reminder today that as enticing as it is, you do not buy foundational elements of your technology that are on the roadmap at any firm. And when somebody tells you that, listen, I come from these technology firms. I worked in them for the last 10 years. Ask to see the roadmap. Ask to see it. Make sure it's real. Dig in. Ask more questions. And make sure that your contracts are structured appropriately to defend your business should you need to do so. Chuck, yep. I love you for sharing that and that you're so forthcoming about the mistakes that you made, because I think that's going to go a long way in helping a lot of people think through their technology decisions, especially as we come to this time period that's going to be a lot of shiny things.
Oh, yeah.
A lot of shiny things to compel us, I think.
Yep. Well, listen, I appreciate you having me on.
Yeah.
Oh, let me just give one last little tidbit for
please.
Reviewing contracts, especially those, I keep forgetting that, the terms of service,
yep.
Which is where they will get you. The terms of service is where they will get you. You know what you do with that? I've been doing this now a lot. Download it, put it into ChatGPT, and ask ChatGPT, what should I be worried about? It's amazing. It will tell you where all those bodies are buried. So that's kind of my parting thought.
It.
Along with Kelly, if you would love to have you continue this conversation with me on Go RIA.
Yes. Yeah? Yes, let's do it. Of course.
I feel there's a little bit more we can dive into, and maybe we can do that on my show.
I would love to. Thanks for the invite. All right, guys, thanks for joining today. Take Chuck's advice, and we'll be back soon. Thanks so much for tuning in. If you enjoyed today's show, subscribe to be notified when new episodes become available. And please consider giving us a 5-star review on Apple or Spotify. This podcast is sponsored by Intentionally, a financial services growth engine design consultancy and agency. If you want to learn more, please email me at kelly@growintentionally.com. Thank you again for listening, and check back to hear what we're not doing next.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Kelly Waltrick. The content has been made available for informational and educational purposes only.